Getting in an important voice, Andrew Holland, CEO of Avendus Capital Alternate Strategies. He's joining us on the show right now. Andrew, good morning to you. Lots been happening. Markets fairly resilient in an extremely volatile environment. Is it time to look at this as an opportunity rather than to sit on cash?
I think it's an opportunity for sure in certain stocks, which will get tarred with the same brush. But I'm not thinking that it's an opportunity to buy the whole market, because there's still. Let's just take away the geopolitical issues for a second. You just seen some China PMI data come out, which is very poor. The US, to my mind, is in recession. So you have a lot of global headwinds in terms of global growth, which I think is slowing very dramatically now, which will affect our market. So I think you're going to get over the next 3 months up until the elections and maybe around the elections, plenty of opportunities to buy this market, but in particular individual stocks, because whilst the index is kind of holding up here, the damage underneath the index in the broader market is still very significant.
Mm-hmm. The other important part now being, while we're also observing the macros and not just the earnings and the micro aspect of it. So today you're going to be seeing the GDP numbers, the quarterly GDP numbers ended December coming out. 6.8% is what we're expecting. But how do you blend both these factors together to take a constructive call on the market?
So let me just kind of sidestep your GDP question for a second. This is how I think things will play out, and this is what we're thinking overall, is that if we're correct that the developed markets are in or heading towards recession, then one thing is for sure, a few things will happen there. One, interest rates will come tumbling down globally, and they will here as well. But the bigger factor is that obviously commodity prices will fall, including oil. So once the kind of dust settles on the slowing growth, and if we have a more stable or stable-ish government where we can see that reform process will continue, then I think India will be off to the races in terms of investments from foreigners, and also will still be one of the fastest growing economies in the world. So I think all of that plays out well. It's just the next 2-3 months is going to remain horribly volatile, which it has been for the last 6 months anyway. So you just have to use these opportunities to pick individual stocks before thinking about the whole market rising, which I think will happen after the elections if any of what I've just said plays out.
Andrew, so let's work with an assumption that it's right now slightly difficult to call the market because of the pushes and pulls. I mean, if indeed the US-China trade decision comes out to be positive, and Robert Lighthizer comments yesterday seem to suggest that the tariff increase might not happen until the talks are on. So there are pushes and pulls, and we can't quite figure out what the benchmark index could do. Would you presume that this is a good time to go out and shop into some of the pockets that have been beaten down due to presumably temporary periods of stress? Autos a case in point.
No, I don't think so. I don't think I'd want to buy into any kind of sectors which I think will continue to underperform. So the auto sector would be one of them. Yes, you will get those kind of moments of positivity for the sector, but I think it's a structural sell. I think it's all over in terms of the great growth that you've seen in the past 3 to 4 years. If anything, now we're just going to see time after time analysts having to reduce the forecasts. In terms of the NBFC sector, which is obviously the other area under stress, this second wave which is happening, I think is probably worse than the first time around in September, October, because I think it's starting to impact the real estate companies, and that's a huge, going to be a huge problem for these NBFC companies. And obviously for the banking system. So I'm just a little bit wary in dipping my toes in beaten down sectors, because I think they'll remain beaten down, if not probably be under further pressure. So I'd rather stick to quality at the moment. I'd hide at the moment. in terms of FMCG, IT, and certain selective stocks, but not really kind of chase this market because of the volatility I talked about, and wait for the opportunities in single stocks.
Just wondering, this pessimism in autos, is it correlated to the stress within the NBFC space, or would you reckon that there are other issues at hand? Because frankly, if you look at just the demand pull, aside of this NBFC glitch that has happened, you don't see too many factors which could be impacting the natural course of demand for the auto names, right?
No, I mean, you're going to get demand for autos, but it's not going to be at the pace it was over the last 4 to 5 years. So that means is that you get maybe single-digit growth. But what that means is basically two things. One is that your margins get squeezed because your operational gearing actually kind of starts to come off. But what you'll see is, company after company either discounting prices or spending more on advertising. So you're going to have all of that, which will affect your margins. So therefore, forecasts have yet to be brought down to the levels at which I think need to be. I think there's another 10 to 15% downgrades to come in this sector. So I don't need to buy it yet. I can wait for those downgrades to happen before looking to buy it. So I'm not saying that overall demand for consumption for cars it's not going to stop. I'm not saying that, but I think the heady days of strong growth, profit growth is over. And the valuations have to reflect that, which they're not, because no one's taken the knife to the profit forecast yet.
You are saying that there is more downside?
Yes, definitely. 10 to 15% downside.
Wow, okay. That's one headline from this interview, Andrew Holland. So thanks for that. The other bit is this very consensus belief about how corporate-facing banks, even PSUs, will have very heady profit growth because of the credit costs coming off. Difficult to time the quarter, but it will happen. Are you in sync? And if you are in sync, are some of these stocks, including the SBIs and the PNBs, if not the smaller ones, or SBI and BOBs, if not the smaller ones, are all of them a buy?
No, I don't think that the whole sector's a buy. I still like the private banks. So what I'm thinking here is it's very simple. We're coming towards the end of the non-performing loan problem for all of the banks, and that will start to reverse going into 2019. We've seen some of it a little bit already, and that's where you're going to get the big earnings kicker for the whole banking sector, and then that's the great news, right? But if we look at the fundamentals, then the private banks have the capital and the balance sheet to go ahead as India continues to grow. All the PSU banks just have the capital just to survive and not really kind of move ahead. So they're going to continue losing market share. So the best case you can say for PSU banks is that they all merge or do something. But I'm not even saying that 1 plus 1 and plus 1 equals 3. It probably doesn't. It's probably less than that. So this is going to be a long kind of process for these banks to either merge into something bigger, and then you've got to look at see what the management's going to do with that and who the management is of some of these larger PSU banks. So I've always said, and I'll continue to say, that PSU banks will have their day in the sun. They always do, but you rent it, you don't own it. There's no need to own PSU banks.
All right. So, you've spoken about banks, you've spoken about autos. Where does the growth come in now from? What is the pocket that you're looking at? Are you going to look at infrastructure as a pocket now, the likes of the L&Ts of the world? Are we going to look more towards investment-driven sectors? Are we going to look at the more expensive consumption-driven sectors, which could likely become even more expensive? But people are ready to pay for it because the opportunity persists. So what is it that you are going to put your finger on and say that this is likely to be a good investment?
So we continue to like FMCG despite the ratings. We think it's both a short and a long-term story that's not going to go away from us. So I'm happy to pay these kind of multiples If anything, if for any reason they come down, then I would continue to buy. So FMCG is a whether you have a bull market or a bear market, you just have to have them in your portfolio. The infrastructure story which you're talking about, I think, is a second half 2019-20 onward story. If you have a stable government, then what you'd see is obviously the government would continue to spend money on infrastructure. Given that a lot of industries now are running at capacity utilization of around 75-78%, they're going to have to start doing some capex. So I expect the private capex cycle to start picking up in the second half of the year. But that's all on the basis that you have a stable government, which will continue with the reform process that we've been seeing in the past 4 or 5 years. So it's a little bit early to do that, but I would look at infrastructure, capital goods, kind of second half of the year. If you're more adventurous, you could obviously take an earlier call, but I think I'd rather just wait. I don't mind missing the first 5-10% if it's a longer term upward trend for the sector, and have that certainty first. The only other sector which is something which looks a little bit more compelling than it has been is pharma. I still can't get myself over the line on the sector because of all the problems that they just kind of seem to keep having. So probably more domestic focused pharma stocks is probably where I'd look to increase weightage. I'm still not convinced I need to be in generic US pharma exposed companies at the moment.
All right. Just one last question. While Q3 this time around for Nifty 50 companies have shown stable growth, about revenue growth of 16%, profit growth of about an average of about 22 odd percent, the market has really not reflected that. If we get a stable government, earnings continue this trajectory. From a market standpoint, the growth in prices, will they match growth in earnings?
So don't forget that last year we had a year where we had actually the last 4 years or so we've had no earnings growth, but the market's moved higher, right? So there's always a bit of catch up to do in terms of earnings, being better and the market's doing nothing, and that's fine. I think our view is that 15% earnings growth for this year, if we're correct that the stable government plus private capex taking off in back end of 2019, then you're probably looking at 20% earnings growth, and I would have thought the market would move in line with that, in line with the earnings growth. So that would be our base case.
Okay, Andrew, we'll leave it at that. Pleasure talking to you today. Thank you so much for taking the time out and being with us.